Tensions between Iran and Israel have escalated, creating what many see as a far more volatile and dangerous environment in the region. Earlier, I spoke with Brad Simpson, Chief Wealth Strategist at TD Wealth, about the implications for markets.
For fixed income, really is the first question is it leads to interest rates, and if you're going to be talking about interest rates, of course you're going to be talking about inflation. And so, because it is where in the area of the world where so much of the oil is immediately a lead to what's going to be the impact on the price of oil. And of course, if oil starts to go up, which we've seen over the last few weeks, a move from kind of like the mid 80 zone up into $90 going into this attack on the weekend, fell off about 1% or so in the last couple of days here again. But if we saw really a change in the oil price, and let's say like for Brent crude over $100, then you'd start to see more of an impact on inflation, which could have a potential impact on interest rates from here. We don't think that's what we're going to see, certainly in the short and midterm of this, anyways. So the other side of the coin, of course, then is in times like this, is there's a flight to safety. And a flight to safety means that there would be a real potential for the market and folks to start moving more into U.S. bonds, which has the potential to push interest rates down, and so that is also that's actually a net positive. So we remain with our fixed income weighting is we are modestly overweight fixed income, and we continue to be very comfortable with that positioning there.
What about on the equities side? We'll get back to the commodities because obviously there was an interplay between commodities and bonds. Let's talk stocks.
Sure. Yeah. Of course, that's I think the big one. I think for investors right now, and especially if you want to frame that through the lens of looking at where most of the global market move has been, and that is the story of the S&P 500. So if you look at it since October 2023, you've seen the S&P rally about 25%. And put onto that in dollar terms, it's added about $12 trillion in market capitalization. This is a market that has moved an awful lot, and it's one that there's been almost no volatility for the last, let's call it 5-6 months either. So this is a market looking for something to build the correct on. And so I would say because this was so well telegraphed, this ended up not being the type of catalyst that the market was looking for. But if you look at over the last few weeks, we have started to see a little bit of correction, and that correction, we think that we're probably going to see more of that in the weeks ahead. There is a lot of headwind here just to try to take some steam out of this market, if you will. And so for that, we think that this is a little bit of a cautionary tale, which leads to right now our weighting in equity markets are neutral, which is what has been going into this. And we think that's a really good way of looking at that right now.